This time I'm going to talk about accounting for premiums and acquisition costs under the default liabilities measurement model. Having covered the revenue in the first episode, now we'll be able to connect the dots and see more clearly how revenue, premiums and acquisition costs fit together in the beautiful logic of IFRS 17. The acquisition costs make a conspicuous income statement position, while premiums are not going to be presented there at all. So from the new income statement perspective, they make an unlikely couple. Nevertheless, I've paired them together because they are both subject to the same tricky calculation, which is ascertaining how much should be apportioned to the CSM and how much should be allotted to the income statement. I'm Pawel Wozniak from 3Blocks, and this is the second episode of Zoom In on IFRS 17. As a rule of thumb, the CSM is adjusted for effects related to the future, and effects associated with premiums and acquisition costs are not exceptions in this respect. What is different in the case is that it's not very obvious what portion relates to which period. The standard itself is sketchy in this area, so the apportioning method I am about to show reflects my own thoughts on that matter. Either way, it will be interesting to see what approach will ultimately be adopted in this regard by the insurance industry. As explained in the previous episode, we recognized in revenue the portion of premiums that corresponds to the projected claims and expenses, recognized acquisition costs, release of the risk adjustment, and the release of the CSM. By definition, revenue is linked to the service provided in the current period. Ergo, the related premium is also linked to the current service. Assuming there is no investment component, the rest of the premium must correspond to the future. Using the analogy to the existing actuarial terminology, we may call the amount corresponding to the revenue the risk premium, and the balancing figure that gives in total the premium paid the savings premium. On this graph, paid premium is depicted by blue bars, risk premium by brown bars, and savings premium by yellow bars. In this example, most of the premium at the beginning of the insurance period corresponds to the future service. That is, it will be used to finance future claims and expenses. Over time, the risk premium becomes bigger and the savings premium smaller, and eventually the risk premium is bigger than the premium paid, which means that the savings premium becomes negative. Positive savings premiums accumulated in the past are used to compensate for negative savings premiums in the later periods. Different products have different risks and savings premium development patterns, but the logic is the same. Now, in cases when savings premium is positive, we may use the risk to savings premium relation to determine what portion corresponds to the future service. In cases when the savings premium is negative, we may regard the whole premium paid as relating to the current service. I talked about splitting the premium, but typically acquisition costs are calculated as a percentage of premiums, hence in most cases we can apply the same allocation. For products where the risk is uniformly distributed, this method simplifies itself to the pro rata temporis allocation, similarly to the non-life insurance companies calculating the unearned premium. I only mean here allocating in a similar way because the accounting under IFRS 17 will be different, with the CSM being part of the picture. Possible simplifications of the presented method include pretending that the risk is evenly distributed even if it's not. Whether such a simplification is acceptable is another question. Today is January 2018 and I haven't seen any presentations, papers, articles or videos that cover this topic. So at this stage, it's difficult to predict what will be the generally accepted accounting practice in this area. Moving to accounting treatment, first we calculate what portion of premiums and acquisition costs relates to the future concerning both projected and actual amounts. Having performed the split, we may calculate the variances on these parts. The experience variance that corresponds to the future is accounted to the CSM, while the experience variance that is linked to the current service is recognized in the income statement. Let's go through the accounting journal entries related to the premiums and acquisition costs, starting with premiums. The part of the projected premiums associated with the current service is credited to the fulfillment cash flows and debited to operating incomes and expenses. At the same time, the part of actual premiums related to the current service is debited to the bank account and credited to the operating incomes and expenses. In consequence, what is really registered as other incomes and expenses is the experience variance corresponding to the current service. IFRS 17 specifically forbids accounting for premiums to revenue, so the premium variance has to be recorded in operating incomes and expenses. Let's see what happens to the future service-related portion of premiums. On one side, the projected premiums are debited to the fulfillment cash flows, and the other side goes to the CSM. When it comes to the actual premiums associated with the future service, they are debited to the bank account and credited to the CSM. As a result, what is actually registered in the CSM is the experience variance related to the future. And lastly, changes in estimates of future premiums are accounted to the CSM. Let's move on to the accounting journal entries for the acquisition costs. The part of the acquisition costs paid corresponding to the current service is credited to the bank account and recognized in the income statement as an expense. Then we have a journal entry explained in the last episode, which represents an amortization of the quasi-DAC. The related amount is credited to the revenue account and debited to the acquisition costs in the income statement. This entry does not have any impact on the profit, but it is needed to ensure completeness of the acquisition costs and the revenue. If, for whatever reason, the acquisition costs are still not complete, we should follow the standard accounting procedure for accruing for missing costs. It may happen when the acquisition costs that were supposed to be paid before the period end had not actually been paid. Then we have the release of the fulfillment cash flows related to the acquisition costs. This journal entry was also explained in the last episode. So now we have the complete revenue associated with the acquisition costs and the complete acquisition costs recognized in the income statement. The difference between these two amounts represents the experience variance relating to the current service. When it comes to the acquisition costs corresponding to the future, on one side the projected amount is debited to the fulfillment cash flows and credited to the CSM. On the other side, the actual amount paid is credited to the bank account and debited to the CSM. In consequence, the future-related experience variance is accounted to the CSM. Lastly, changes in estimates of future payments of the acquisition costs are accounted to the CSM. To summarize the key points, accounting for premiums and acquisition costs entails splitting them into the part that relates to the current service and the part that relates to the future. From the profit calculation perspective, the financial result is directly affected only by the experience variances. For example, if the actually paid premium were equal to those projected, then the premiums wouldn't have any direct impact on the income statement. Thank you for watching and good luck with cracking premiums and acquisition costs.